This shifting steel vault mechanism represents the physical reality of corporate actions. These maneuvers physically reconfigure a company's capital structure, changing the internal gears of ownership and debt. Because these actions involve altering the mathematical ownership of a company, they operate under a strict regulatory triad. Every maneuver must comply with the Companies Act of 2013, regulations set by the Securities and Exchange Board of India, and the specific listing agreements of the stock exchanges. This regulatory matrix exists for a specific reason: preventing information asymmetry. Controlling interests and promoters have perfect visibility into the company's health. The rules ensure that when the capital structure shifts, minority shareholders are protected from wealth extraction. To understand exactly how these mechanisms work, we are going to simulate these specific actions directly on a balance sheet. This strips away market sentiment and isolates the true mathematical impact on a company's intrinsic valuation. For an equity research analyst, a corporate action acts as a mathematical trigger that immediately invalidates old financial models and requires a complete recalculation of the firm's worth. The operational reality of execution relies on strict timing. Corporate benefits do not apply to the market broadly. They apply exclusively to investors who are physically registered on the company's cap table at a specific designated moment. Two critical timeline constraints govern this process. The company announces a record date, the exact day you must be on the books to receive the benefit, and a book closure period, during which the register is frozen to process the action. This split-screen dashboard maps how we measure capital shifts. On the left is the standard balance sheet. On the right, we track the three metrics an analyst uses to measure the impact of any corporate action: total equity, outstanding shares, and earnings per share. These three metrics act as a lie detector. By watching how they move, you can instantly separate corporate actions that create actual wealth from actions that merely shuffle paper. Knowing exactly when an action mathematically executes is as critical as knowing what the action is. The moment the record date passes, the market price instantly recalibrates to reflect the new structure. We begin with accounting adjustments. These are corporate actions that alter unit metrics like share count, but have zero absolute impact on the economic value of the firm. A prime example is a bonus issue. This is the process where a company capitalizes its existing reserves to issue free shares to existing shareholders. On the balance sheet, capital drains from reserves into paid-up capital. Money simply moved between equity pockets. On the dashboard, total equity remains static, while outstanding shares rapidly tick upward. Consequently, earnings per share drops proportionally to absorb the new shares. This action yields no economic benefit to the investor. It acts purely as a psychological trigger for retail buyers and a mechanism to increase liquidity by lowering the per-share trading price. A bonus issue is often confused with a stock split, but they operate differently. A stock split doesn't even move funds between equity accounts on the balance sheet. In this diagram, we see the mechanics of a stock split. A single share block splits into 5 smaller blocks. The face value automatically divides by 5, while the outstanding shares counter multiplies by 5. Notice that the balance sheet remains entirely frozen. A share consolidation is the exact reverse engineering of this process. Watch the 5 small share blocks merge back into 1. The face value multiplies, and outstanding shares divide. Companies use this strategically to boost a depressed per-share price and improve market perception. These volume-based actions are a mathematical sleight of hand. They change the denominator, but leave the firm's intrinsic value and total market capitalization entirely untouched. Next, we move to value modifiers. These are actions that permanently shrink or expand the actual economic base of the company. This dashboard shows the mechanics of a cash dividend. Cash decreases on the asset side, while retained earnings decreases by the exact same amount on the equity side. Real capital has physically left the firm. Because that cash is gone, the stock price on the open exchange automatically adjusts downward on the ex-dividend date. The company is now mathematically worth less by the exact amount of the payout. A share buyback achieves a similar wealth transfer, but through a highly regulated mechanism of purchasing and extinguishing existing shares. During a buyback, cash and reserves drop. Shares are legally extinguished, driving the outstanding shares counter down. Because this denominator shrinks, earnings per share artificially inflates. Total profit remains identical, but remaining shares appear more profitable. Because buybacks drain cash, Regulators place strict constraints on the process. A firm cannot proceed with a buyback if it has defaulted on its debt obligations or preferred dividend payments. Value modifiers permanently shrink the company's asset base. When cash leaves the balance sheet, analysts discard their historical models and recalculate the worth of the remaining enterprise from scratch. Occasionally, a firm urgently requires fresh equity capital to fund expansion or pay down toxic debt. Instead of going to the open market, they deploy a rights issue. This mechanism offers newly minted, discounted shares exclusively to existing investors. The balance sheet reflects the capital injection. New cash flows into the asset side, and paid-up capital expands on the equity side. Total equity grows. But this creates an immediate threat for minority shareholders. If an investor ignores the rights issue, their proportional ownership of the company is instantly diluted by the new shares flooding the cap table. A rational investor is forced to make a choice: exercise the right by committing more personal capital to maintain their stake, or renounce the entitlement by selling it for cash on the open exchange. A rights issue is a defensive problem. It forces investors to either commit more capital or accept a permanent reduction in their ownership percentage and voting power. These merging droplets of mercury illustrate the shift from internal balance sheet adjustments to total structural transformations involving multiple corporate entities. Mergers and acquisitions are the ultimate exercise in ownership consolidation, where one entity absorbs the assets and liabilities of another. This diagram shows the mechanics of a share swap during an acquisition. The acquirer entity issues newly minted shares, using them as currency. These are transferred to the shareholders of the target entity, dissolving the target and absorbing it into the parent. Before this transaction executes, independent valuation is required to establish a precise, fair share swap ratio. Both companies must be accurately priced to ensure neither set of shareholders is diluted unfairly. The opposite maneuver is a demerger, or spin-off. This is the intentional fracturing of a business division into its own separate legal entity. Watch the ownership distribution mechanics of a demerger. A single corporate block fractures into two. The exact shareholder list from the parent company is proportionally duplicated and applied directly to the cap table of the newly formed entity. The strategic rationale here is clear. Conglomerates use demergers to reveal and separate the market value of distinct business models previously obscured within a larger corporate shell. Structural transformations destroy all historical financial baselines. Past earnings and old balance sheets are rendered useless, requiring analysts to build entirely new valuation models based on the new entity's footprint. The final corporate action is delisting, the permanent removal of a company's shares from the public exchange. Delisting comes in two forms. Compulsory delisting is a regulatory penalty for non-compliance. Voluntary delisting is a strategic choice by promoters to take the company private. To protect minority shareholders during a voluntary exit, SEBI mandates a strict price discovery mechanism, known as reverse book building. This bid ladder maps the first step. The controlling promoter sets a baseline floor price for the stock at the bottom. Minority shareholders submit exit prices. These bids cluster above the floor, driving the acquisition cost to a fair premium. A progress bar tracks promoter ownership. To succeed, they must hit a locked 90% threshold. If they miss it, the exit fails. If the delisting succeeds, a fallback mechanism protects the remaining public shareholders. They retain the legal right to sell their shares to the promoters at the final exit price for 1 full year. A stock price is strictly bound to the rigid mechanics of a company's capital structure. For a professional, tracking corporate actions is the only reliable method for determining true intrinsic value.